Hello, hello, hello. How is everyone today? Pin you. Nice to see everyone. It's been a while. I uh, I had a trip to England, and then I had my son's award ceremony last Friday. So Alex has been kindly helping me, which I appreciate. But it
Yeah.
does feel like forever since I've been here. So nice to be back. Although I'm not going to lie, for those of you in England, I am extremely excited to be back in Africa. Uh, November in England is an interesting time. I don't know what it's like for you, Shona, but it's in London. It was pretty chilly when I arrived in Ireland. Actually, it's been 3 weeks, hasn't it? Because the first week I was in Limerick with Paul. When I arrived in Ireland, it was -1, and the real feel was -8. And I literally like arrived, got off the plane. I was like, oh shit, I didn't bring my gloves or my beanie or, whatever. I was like very underprepared for the whole thing. Anyway, it was a lovely trip, good trip with Paul. Lovely to watch rugby. Actually met up with one of our mastermind members, Evan, and watched the rugby with him. And then traveled over to England, and we had one of our mastermind, just a social catch up, which was lovely to see the people who joined us there in London. And then I presented with Paul on the Tuesday and flew home on the Wednesday. So it was all a bit of a whirlwind trip in terms of the whole process. However, today is about Q&A. So I'd like to kind of start off as always and find out if there's any questions, any thoughts. I do have the whole calendar booked for next year. So for the mastermind members, you'll be relieved to know that the entire year is booked. It's all been confirmed with Anthony and Garth and the Calio team and everyone. I'm just waiting for my own team, actually, just to make sure if there's any clashes with birthdays or weddings or whatever. But we should have that released by Monday, just so that you all know. And then once that's released, it'll be released with all the mastermind members, and then the different calendars will be updated. And I'm sure everyone else can figure this out. We start with the mastermind ecosystem for the year, and then we reverse engineer it for wealth hackers, etc. So yeah, all the big milestones are all sorted basically in terms of that process. Right, any questions, any thoughts, any updates? Could someone give me a bit of an update as to kind of where you're at with Alex? Obviously, I'm running a rhythm here, and I know Alex and I have sort of overlapped a little bit, and I asked him to sort of cover, in the first week, I asked him to cover the know your numbers and to kind of not regroup, that's not the right word, but anyway, you know what I mean. In terms of go over what we went through, the know your numbers. I must admit, I found that a very, very powerful session, and it's so much so that we're going to redo it on the 17th and 18th of Jan. So for those who missed it, if you weren't able to be there, we're going to be redoing the session on the 17th and 18th of Jan. And the reason being, I think it's incredibly powerful. And funny enough, I don't know if Alan's here and some of the others that were asking, for things, but things like the investor language and all of that, we really tried to go quite deep into that in terms of that process. So we're going to be redoing that. No questions. I'm going to have to rename the session. We'll just have to call it strategy session because there's no point in calling it Q&A in terms of the process. Okay, well let's rock and roll in. So which screen do I need to share now? So I'm going to share that screen. Okay, so you can see that I'm in the wealth hackers here. Just by the way, I mean, anyone, I know this is being recorded, but anyone live, if you're not in the wealth hackers, you should be. Even if you're a mastermind member, you should still be in the wealth hackers. I haven't had a chance yet to transfer it over to the mastermind, which I will, but I just haven't had a chance. So if you go here, you'll see that within the wealth hackers, you've not only got access to the know your numbers, so everything's here. The entire course is here now, the full 2 days. So if you don't want to wait till the 17th and 18th and do it live with me, you can actually watch all the modules. They're all here. Everything's here. The PowerPoints are below, all the cheat sheets, everything's here. So I've built everything out completely, so you've got it all. But where I wanted to go was here, which is the Wealth Transformation Pack. And as I promised everyone, and we spoke about this a few times in terms of making sure that this was available for everyone. it's now here. So you've got the different areas. You've got your mindset and purpose. You've got your core wealth principles. You've got your passive income. You've got your investment vehicles and strategy. You've got your advanced mastery, and you've got your big picture. Okay, so we go to mindset and purpose just to show you. We started on this journey where we did the return to the inner child. We then did the investor learning journey, and we did the investor mindset, like how to shift from the E, the S, the B, and the I to the I. Yep, everyone with me so far? That's what we've been through already. Okay, then we went to the next one, which was the core wealth principles. And my understanding is, oh, okay, I'm just going to mute everyone. If you want to talk, just unmute yourself. Someone's got echoes. My understanding is that we today are going to be going through this one, because we did wealth, we did what school never taught you. We did the financial foundations of financial freedom. We've played this game here, so I'm not going to play it today unless people want to. But again, I remind people that if you want to play the game, the wealth game, you can literally click here and it'll take you to the digital version of the wealth game. Or you can go down, if you're old school like me and like to print stuff out, you can go and click on it and open it and print it. Okay, so you've got both options there, basically. In terms of ROI, cash on cash, yield, etc. So this is the investment language. We have been through this before. Okay, and this is the one that I want to focus on today, unless you and Alex have covered this already. And we have discussed this multiple times. So I would like to know if it's worth me spending the session today on this, or if we move to the next one. And do me a favor, just type in the chat box, let me know. So if we go down and we basically go to understanding investor language, you'll see that this one here is where we just basically break down all of this jargon. Now, we've been through it in the, I know I've done an entire session on investor language. I've also done the know your numbers, and I know I've done it on one of these Friday sessions. So yeah, Marge is asking, yes, please, number 4, understanding investor language. Okay, cool. Okay, anyone else? Just give me some feedback quickly in terms of where you're at. Okay, so I'm going to go through it. So you got the document. I'm going to go through it, and then you can, sorry, just 2 seconds. My window's blowing. Just 2 seconds. It's very, very hot here, and I've got the blinds closed so that you can see me properly. But then when the wind's blowing, it's for the doors being open, it's making a big noise. So Shona said, I'm okay with the investor language. Always good to hear it again. Gerrit said, happy to move on. Please do it again. Okay. So I think there's general. Okay. So what we basically going to do is let's run through this at a level. So you've got this document, and this document's been put together to help you understand the different terms, because there's critical terms when it comes to investing that you need to understand: ROI, cash on cash, IRR, yield, and cap rate. So you'll see here that basically it explains what they are. So yield reveals how efficiently an asset generates income. This is the one that the middle class use, that estate agents use. It's a very, very simple, rudimentary metric. It's generally gross. So, it doesn't calculate what's actually going to end up in your pocket, and it tends to be a gross return. So it's a very easy thing to calculate, but it's very middle class and mom and pop retail investor. So just to be very clear on that. If you compare it with cash on cash, that shows you how hard your actual money is working, because it's the cash that's physically being put in your pocket. So this is the net return in your pocket. So the difference between a mom and pop investor is they talk retail and they talk yield, and a more sophisticated top 1% institutional investor will talk cash on cash, because it's actually about the return in your pocket. Okay, the next one is ROI. It gives a big picture, so return on investment, gives a big picture view of the total return of the life of an investment. So again, it's generally gross. It doesn't take time value of money into account. Sometimes it does, sometimes it doesn't. But because it's gross, it always looks good on paper. So again, estate agents love to use this. Marketeer people love to use this. The financial industry loves to use this because it looks bloody amazing. You know, you're getting a 20 or 25% return, but they don't tell you that that's over 5 years, and you're actually getting 5% a year or less if you take time value of money into account. I'm just giving you an example. IRR, internal rate of return, uncovers the true time-weighted performance of internal efficiency. So that's a complicated way of saying something. There's 27 different variables that are involved in IRR, 27. You don't have to know how to calculate IRR. You don't have to know what the 27 variables are. I don't either. It takes into account all of the variables though. So it takes into account things like time value of money, capital growth, income, inflation, and 27 of those variables. But what it ultimately helps calculate for you is what is the total return per year after inflation, basically taking into account time value of money, etc. What is the total return you're getting per year? So if you see that you're getting a 15% IRR, it means you're getting a total return with both income and capital growth of 15% a year. It's the single most important metric. If you want to know one metric across all the metrics, IRR is the single most important metric. Because when you understand an IRR, you can compare apples with oranges. If your broker is like, hey, I can help you invest in the stock market and I'm going to get you an 8% return. And your mate down the road is, hey, I can sell you a property and I'm going to get you a Y% return. And your other buddy down the road, the hairdresser, wants to sell you some gold. The way that you can compare apples with oranges and bananas is with IRR. Now, I did do this live and I'm going to do it again for you live now. So let's do it quickly here. Let's do a little ChatGPT lesson. So people come to me and they say, yeah, but Scott, I don't know how to calculate IRR. Well, neither do I, to be honest. You don't have to. In a regulated industry, if someone tells you that it's the IRR, it has to be right. And there's only one way to calculate the IRR. So if they tell you that the IRR is X, they actually regulate it like to make sure that number's right. So what's great is that if I had the different metrics, I could actually talk about a deal into ChatGPT and it would tell me what the IRR is. And if it didn't know what some of the metrics were, it would ask me to go and get them. Now, the best thing is I don't want to actually go and have to do this myself. So ideally, I want to be able to have 3 different assets. And if that stockbroker got hold of me and said that they were getting an 8% return, my very first question I would say to them is, well, what is the IRR? Don't give me the fancy numbers and this and the ROI, all that shit. I'm not interested. What is the IRR, internal rate of return? And they give you a number, and that has to be specific. They can lose their license if they give you the wrong number. Chances are they won't even know what it is. I just want to be very clear on that. And that's a good sign to know that you're dealing with the wrong person. But now let's say Alan's asked me a few times, should I invest in the stock market? Should I invest in property? Or should I invest in gold? So do me a favor, type in the chat room quickly. If you take the last 10 years, should I, based on IRR, which is total return, should I have invested in gold, in the stock market, or in property? Which one has a better IRR? Just a matter of interest. Let's see. Let's just see where people sit. So Shevin says gold, Kevin says gold, Safina says stock market, Seagrin says gold, stock market. Okay, so you see this is interesting. I don't know the answer, okay? But this is so amazing. I don't know. I mean, ChatGPT just blows me away. So let me show you how easy this is. Funny enough, I'm on a course with Tony Robbins and they were teaching people how to do this. And I was like, what? Don't people know how to do this? So look here. Right, so please tell me over the last 10 years, if I was to compare gold, the stock market, as in the S&P 500, and average residential property in the UK, what is the long-term 10-year IRR, internal rate of return, for all 3 of those asset classes, and which one would have been better to invest in if I had $100,000? So now we see whether Richard was right with property, or Millicent with stock, or Mariam with gold. You see how lovely it is? All 3 of you had different things. Why I'm doing this, I'm doing this for two different reasons. I'm firstly showing you how easy it is to actually ask these questions using ChatGPT. And secondly, I'm showing you that if you were trying to compare gold, the stock market, and property, there's no other way to do it other than through internal rate of return. Okay, so let's see what it says here. So, while the exact analyzed IRR depends on dividend reinvestment, etc. Okay, I get that. You're looking at about 7 to 10% per year. Okay. Gold, 8.75, is that right? Yeah, there are analyzed returns, 8.7. And UK residential, 3.2. No, that's not right, because that's an ROI calculation. It's interesting. See, it's battling to calculate the IRR because it doesn't know the income. Okay. So that basically what it's saying there is, like, you're not comparing an apple with an apple there, just to be honest, apple there with an orange, because that's an IRR, that's an IRR, and that's an ROI. But I think you get the point. On a pure appreciation, gold seems to be slightly edge equities. If you reinvest the dividends and stay invested through volatility, S&P 500, and UK residential property has lagged both gold and US equities. If you just look at appreciation, but that's not taking into account income. Are you with me so far in terms of just how you can do this? Is this making sense? And see this comment, commercial. Oh, you were saying commercial property. Yeah. Let's just ask that. Let's just go back to ChatGPT and just ask. Can you do the same 10-year analysis for the S&P 500, the internal rate of return for the S&P 500, assuming that they reinvest all dividends, for gold, and also for commercial property in the UK, assuming they reinvest all dividends or income? I don't know if it's just me. Like, I don't know if I'm a little geek. Do you guys actually enjoy this? Like playing around with ChatGPT and asking these questions? Like, firstly, are you learning? Like, does everyone actually know how to use ChatGPT? I don't know. Like, I assumed everyone knew how to do this. I literally, I thought this was like going to school. And then I went on this course with Tony Robbins. They were teaching people you could do voice activation. I'm like, are you joking? I didn't know that. Didn't know people didn't know that. Okay, so what's it trying to tell us here? There are analyzed return of 13.4. It's still saying nominal. Why is it not giving me the IRRs? So it can't find reliable to compute. Interesting. See, property is always a challenge because the data is always really, really opaque. So what becomes useful is if you're trying to compare like the stock market to gold to a specific property, then it makes it much easier to make a decision. Data is too patchy to give defensible numbers. Could have been attractive in certain sectors, but too many variables. Yeah, okay, fair enough. If I invested 100,000 in 2015 and could pick one of the three with no leverage, no special property management, I'd have picked the S&P 500 with dividends reinvested. If I allowed to invest in UK commercial property, only as a small percentage of a diversified portfolio, and only if I could pick good deals, location, yield, accuracy, I might consider it as a diversification overlay. For gold, I'll treat it as a hedge or insurance, inflation, market downside, rather than core return engine. Interesting, eh? Yeah, and I mean, again, obviously, Richard, you're asking is gold staked and whatever. I mean, we can spend all afternoon asking questions. I'm just trying to show people how you can do this and why this is relevant, because I don't want to get off track with why we're here. We're here to talk about the metrics. So if you can speak the language, and literally if you can speak English or quite frankly any other language, you can just talk to ChatGPT and you can ask it these questions so that you can start to see how this works. Someone asked the cash on cash question above, so I'm just going to come back to that before I move on from IRR. Where was cash on cash? What was it? Oh, yeah. Archie said, is cash on cash over the life of the investment or per year? It's per year. So if it says 10% cash on cash, it means you're getting, if you put in $100 or £100 in your case, Archie, because you're in England, and it's a 10% cash on cash, it means you're getting £10 a year. So if you've got $100 cash invested in the deal and you're getting $10 in income per year, then that would be a 10% cash on cash, and you're getting 10% a year cash on cash. Hopefully that makes sense. Okay, right. I just want to make sure, are you seeing the right thing? Are you seeing cash on cash ROI? I sometimes share the wrong screen. Let me make sure I'm sharing the right screen. Yeah, okay, I think I am. Okay, the next one, cap rate. Okay, this is probably the one that confuses people the most. This is the way to calculate the valuation for a commercial property. Now, cap rate stands for capitalization rate, and it helps you understand how the market values the income stream of a property relevant to its current price. So that's a fancy way of saying that, again, retail investors, mom and pop retail investors, invest for capital growth, okay, all around the world. I bought crypto, it went up in price. I bought the stock market, it went up in price. Do you know I bought Apple, it went up in price. I bought Tesla. Do you know I bought that house in London, it's gone up in price. Mark my words, listen to the conversations that anyone has around money, and if they're middle class, professional, retail, or mom and pop, or all four of the above, because most people are all four of the above, they talk about capital growth. Top 1%, talk about income. So a capitalization rate is working out how much return you're getting, income, and what the price of the property should be based on the income that the property is generating. It's always generally for commercial property, commercial real estate. And what's really interesting and what confuses the hell out of people is that if the cap rate gets smaller, then the price of property goes up. So let me explain myself here. Let me show you what I mean. Okay. A very quick course here. Okay, so let's just go here. So property value. Okay, so if you've got an income of 100,000 per year, okay, and if the cap rate is 10%, the way you work out the value is you sorry, I'm not spelling very well today. Is you basically go the income divided by the cap rate. Okay, so I'm just going to put this, it doesn't matter what currency, I'm just putting it here so you can see it easily. So you can see that if you were getting $100,000 a year in income and the cap rate was 10%, then the value of your property would be $1 million. Okay? Now, let's look at a couple of scenarios here. So let's drag this over to the right. So now you want to make money in property. Can anyone tell me in commercial property, there's only two ways to make money in commercial property? Can anyone tell me? Anyone? Type in the chat box. I'm interested to see. Tax. Okay, well done. So Kevin's got the first one, raise the rent. So imagine that this building was partly vacant and I don't know, it had like 20% of the building was sitting empty and you managed to go and find a Starbucks. Or remember the guy that at the mastermind that taught us a great thing. They go and buy old shopping centers where you used to have to have plenty of parking. And nowadays you don't need as much parking because there's Uber. And so they go and sell a portion of the parking lot to a Starbucks and suddenly you get more rent. So suddenly the rent goes to 120,000. And you can see now, oops, sorry, that's gone up. Let's just get this right. I want to keep all these numbers exactly the same. Can you see now that the property has gone up by 1.2 million? So now you made 200,000 profit. Does this make sense? Please just type a yes in the chat room. I know for Safina and some of the others that do commercial property, I'm sorry, this is sort of entry level stuff. But I mean, it's literally, there's only two ways to make money in property. So the first one, you're in complete control of, option one. And this is what everyone tries to do in property, is it's like, right, buy something and find a way to add value. And the only way to add value, if you know anything about property, like particularly commercial property, is to increase the rent. That's the only way to do it. Option two, anyone want to tell me what option two is? So Savina, you're not wrong. I could probably add developers option three. But Archie got the one I'm looking for, which is reduce the cap rate. So I was going to be a little bit facetious and say go to church, because option two is go to church, hope and pray, because you have to hope that cap rates come down. There's no way to influence cap rates. You as an individual, there's nothing you can do. It's a market sentiment, and it's the entire market, and there's no way to influence the cap rate. So let's say that you buy this in a time where there's a lot of uncertainty, maybe it's the middle of COVID and buyers are nervous, etc. Then the chances are the cap rate will be like 10%. But then suddenly the government brings a lot of quantitative easing in, and money's easy to make, and people are taking more risk, and there's kind of better deals, or not better deals, but people are throwing more money at deals, etc. And the cap rate comes down to 8%. Look at the value in the price there. So let's just copy this. I just want to get what is it, D? So this one here has to be, oh, come on, man. What did I do there? That one. Can you see that that's actually gone up by another $50,000? So you haven't changed the rent at all, but it's actually 50,000 more than what you had in scenario one, in option one. Is this starting to make a lot of sense? But I want to be very clear. There's nothing you can do to change the cap rate. Nothing. Zero. You have to go to church or to the mosque or to whatever you choose to go to, and you have to hope and pray, because there's nothing you can do. Now, just in my interest, you have a thing like what's happened in the last couple of years before the interest rates. So when the interest rates went up, this changed. But before the interest rates went up, look at this number. So look at how much profit this person makes now. They've done nothing. They haven't increased the rent. They've done nothing. But the market moved from a 10% cap to a 6% cap. They've made themselves $466,000 profit. Okay, are you with me so far? Now, just by the way, if you buy a property for this much at a 6% cap, and you think the world's going to be good for the rest of time, and then suddenly interest rates come in, like it's happened in the last 2 years, and interest rates have gone through the roof, why do you think so many properties are underwater? Because now it's a 10% cap. The value's gone from 1.6 million to 1 million, or whatever the rental is. And the only thing that the operator can do is influence the rent. That's all they can do. They can't influence the cap rate. And so the property's gone down in value by a third. Starting to make sense? Do me a favor. Is this valuable? I'd love to know in the chat box if this is valuable for you. Now let's ask Archie's question, because I'd love to see what ChatGPT would say. So, how is the capitalization rate calculated in a given sector, region, country when it comes to commercial property? I'm giving you two lessons at once. I'm teaching you the lesson and I'm teaching you how to use ChatGPT. Marge said, how do you know what the cap rate is before you buy? You should know, Marge. So you should know what the current market cap rate is. Again, you could use ChatGPT to find it out. But it's like knowing where you are. Like, what is the current capitalization rate? And you also need to stress test the capitalization rate, because sometimes people say we're buying it at 6 and we expect it to go to a 4. So all you investors are going to make lots of money. That's what happens all the time. And then you ask them a question, you say, well, when was the last time it was a 4? It's like the 20-year average has been a 7. And it's like, no, the chances are it's not going to go to 4, is it? Easiest way to make money is on a spreadsheet. Okay, the basic formula. So, no, that's giving you the formula. Yeah, it's hard to, that's why I was interested to see what it said here. It's hard to, like, it's almost like it's just a metric that you get. And if you, depending on what country you're in, there's literally like, it's just kind of, it's like knowing the interest rate, I suppose, the best way to describe it. Like, it's just, there is a rate and you just have to go and Google it. So I'm obviously doing this at broad base and just asking, but if we were looking at industrial property in Phoenix, there's a cap rate, a current cap rate for industrial property in Phoenix. You just would Google it. But I mean, here you can see the typical cap rates. But again, this is long. Obviously, it makes a big difference between geography, location, and everything in between. But it's a great question, Marge, because you should, if you're talking to anyone that's got any sense in commercial property, you should be saying to them, well, what is the current cap rate? And do these assumptions make sense? What determines the cap rate reduction? So again, this here is sentiment. That's it. It's sentiment. It's human emotion. Things like interest rates going up and down, COVID, tariffs. It's basically sentiment. It's how good do business people feel and investors feel about the state of the market. If they feel bad, then cap rates are higher. If they feel good, then cap rates are lower. Okay. I think we've probably covered cap rates, and hopefully you've seen the massive difference. And as I said, there's only two options. There's a third one, which Safina said, option 3, and that's to develop. So this is cap rate, and this is income. But I mean, other than for people like Safina that are actually going to go out and do development, there's obviously a huge amount of risk in this, specifically in terms of execution risk. And my strong, is that enough strongs for you? Very strong recommendation is do not do development unless you seriously know what you're doing. I have an honors degree cum laude in property, construction management and technology. I have a master's degree in construction and technology. I spent 5 years working for an Irish company in London. I got 2 bursaries, one for my honors degree and for my master's degree. I've spent time on site. I have built tall buildings. I have developed and done development myself. And in about 2008, I said, never again. Because what I learned was that the majority of developers, almost every single developer I know, has gone bankrupt. Do me a favor, go back and look at everyone that's been successful or anyone you know that's been a developer. They've always gone bankrupt. And I'll tell you why they go bankrupt. They start with, let me stop sharing here so you can see me properly. They start with one house and they renovate that house and they sell it and they make a profit. And then they think, oh, well, to make more money, I've got to do 2 houses. So they do 2 houses and they, do whatever, develop it, build it, whatever, make a profit. Like, oh, I want to make more money. I'll tell you what I'll do. I'll do 4 houses. Great. 4 houses become 8 houses. 8 houses become 16 houses. 16 becomes 32. Obviously, it's not 100% linear, but you get my point. Suddenly, they do one of two things. They're either suddenly doing 200 houses, or they go into commercial, big, large-scale commercial. And the problem is that there's only so much they can control. Because when it comes to development, you buy the land, you've got to get the zoning. It takes time, a lot of time, years, not months, years. There's a whole bunch of things. Then you're about to start your development and some greenie comes along. I apologize if anyone's a greenie. And they find some sacred frog that's never been found in London before. No one gives a shit about this frog, but suddenly they care because it's on your piece of land. And then you've got to bring in environmentalists and like all the costs that you didn't think of, and there's more delays. And then anyway, you pre-sell the development, you think you've made so much money, but then halfway through the development, you have COVID. And all hell breaks loose, and like all the buyers pull out and interest rates go up. And you basically, in simple terms, what I've learned with developers, one of two things. One is that they overexpose themselves. So they're always betting on the next big thing. And the bets get bigger and bigger and bigger. It's like going to the casino, bet bigger, bet bigger, bet bigger until the chips come off the table. And the second thing for me on developers is that shit happens that's completely out of your control. And you can turn, I don't care what country you want to talk about. If you want to talk about England, we can talk about Barratt Homes. I can talk about all the big developers because they all nearly saw their ass in 2008, 2009. Many of them did, and only a few got through. And in South Africa, the biggest residential listed developer is Baldwin. The guy's name's Steve Brooks. I know him personally. I've sold hundreds of his properties. And if he hadn't had a bailout from a Jewish financier in 2008, would have gone bankrupt. He got a bailout. That guy helped him. They listed. They're now the biggest developer in South Africa. But they've all followed the cycle. I'm yet to find someone that hasn't followed the cycle. So why don't I want to be a developer? Sounds a bit stressful, don't you think? Compared to just buying a building and holding it. Now, don't get me wrong. I know you can make more money just building and whatever. But actually, the real value is in holding. And so I think if I was to go with what Safina was saying, probably be the hybrid strategy, which I think is the best one, which is if you build 100 units, sell off 50, keep 50. And ideally actually get to the point where you sell it, you take the money, you recapitalize, you own the asset, you build a balance sheet on the asset, and you keep building income. That's the safest way to do it. But personally, I just decided 15 years ago, no, I always want to be a developer, by the way. If you met Scott Picken at 20, I did my first development when I was 13, my first property project when I was 13. I did my first real development when I was 19. I was a student at university. There was a triple garage. My 5 mates were in the house, renting the house. So I went to the landlord and I said, right, I'm going to take your triple garage, and at my cost, my friend as well, we had a bursary at the time, I'm going to take my bursary money and I'm going to redevelop the garage into 2 bedrooms, 2 bathrooms. We did everything. We put the plumbing in, we put carpets in, we bricked up the walls, you got a garage door and all that. We did all of that. We put doors in on both sides. We put a whole sewage system in. It was quite sophisticated. And we were like, awesome. And the deal was with the landlord was that we would do this. We stayed rent-free for a year. And then after that, he would have a house that was 7 bedrooms and he could rent it out forever. He loved the idea. I loved the idea. Everyone loved the idea. You know who didn't love the idea? The planning department. One small minor detail. You're supposed to get planning for the stuff before you do it. So literally within the week of us finishing, my mate and I there, we're flipping so proud of ourselves. It's 1998. I'm in 4th year university. And the guy walks down the driveway. I'm like, who are you? And he's like, I'm the planning engineer. He says, please, can you show me your I don't even know what's called, reports or whatever for your planning? I'm like, we don't need planning. We just converted a garage. He was like, no, you need planning. You're over the builder's line and all that sort of shit. Anyway, we were told to move out. And we were like, well, we can't move out. We've got nowhere to live. We've spent all our money on renovating this garage. So we persuaded not just him, but his boss. We had to go, and if you know Cape Town, we had to go to the building that's got Nelson Mandela, like the massive civic buildings. We had to go there and we had to persuade the big boss. The two students were able to stay in this garage for a year. We had to put back the garage doors. My mate lived behind the garage door, no light for an entire year. Okay, and then at the end of the year, we had to dismantle the whole thing. So this does end with a bit of a, I don't know if you're enjoying this, but anyway, this ends with a bit of a funny story. So firstly, my mate's girlfriend can't get out. Okay? She can't push the garage door. So she would like get trapped in the building. Like she couldn't literally physically leave the building. So that's the first thing that was very humorous, which we still to this day laugh about. But worse than that, I took my son to show him this project about a couple of years ago. And I drive into the building, into the house to show him. And where the sinkhole was, clearly me and Mr. Engineer, my mate, I was construction management, my mate was electrical engineering. We thought we were quite clever at the time. Clearly our tank, our septic tank hadn't worked so well. And the whole bloody garden had like fallen in and the neighbor's wall had fallen over. So anyway, needless to say, don't let students do developments, is all I'm saying. Let's go back to know your numbers. But that was my very first development, which didn't quite go according to plan. Right. Where were we? Okay, and then the last one is risk-adjusted return. Now, when I first did this document, I didn't actually have this in, and I decided to add it. It's even more complicated, but this is a great way to discuss the risk involved in an asset. So like buying Bitcoin as an example, it might have major upside, but it's also got massive volatility, and therefore it's got a huge amount of risk. So what you're trying to do is compare what is the return you're getting with how much risk you're getting. And obviously, ideally, you want to have a high return and as low a possible risk. So risk-adjusted return helps measure how much return is earned on each unit of risk taken. It's called the Sharpe ratio. By the way, I didn't know this until about a month ago when I Googled this. It basically helps investors compare investments by factoring in volatility and risk, not just raw returns. From my knowledge, and equally, I went and researched this to add this to this document. Things like the Sharpe return and whatever, and this risk-adjusted return is very, very difficult to do in like property. You know, like if you're buying a property in Manhattan or something. It tends to be in listed markets that they do this. Anyway, but if you look here, so you can see here, when do you understand? So it tells you about these different things. The wealthier investors don't rely on hope, they rely on understanding. Most importantly, understanding the language protects you. It helps you ask better questions, recognize hidden risks, and build a strategy grounded in real numbers, not emotional guesswork. If you want to play the wealth game like a pro, you must first learn to read the scoreboard. This isn't optional, it's foundational. And once you understand it, you'll never look back at an investment the same way again. And then what I've done, and again, I don't think I need to baby you to literally go through every one of them. But what I've basically done is you can see here, like there's the 6 things. There's the formula if you really want to know. I don't know how to calculate these things and I've got no desire to. What is the meaning? What's the most important thing is you need to know what the meaning is. You need to know why to use it. Okay, then what's the focus? Okay, then there's a table here. So like, what's the differences? So again, you've got time value of money. You got includes capital gain, you got reflects leverage, you got simple and fast to calculate, and you got used in UK buy to let. It's just giving an example of like residential property. Okay, you'll notice risk-adjusted returns not even here because it only works in the listed sector. Then you got use cases, so it basically talks about what it's best for and its common uses. There's an example here. So this is just again $100,000 or pounds that you invest. And like, what would be the breakdown of the different ways? So, I mean, I like to always use numbers to actually understand what it just said to me. So you can go and see there, like gross yield, net yield. So again, minus costs, cap rate, it's all here. Like it explains it all to you. It even's got the risk-adjusted return and how to calculate it. Okay, I'm going to go into that a little bit more detail. And then I actually did this on purpose. If you are interested in the risk-adjusted return, there's a whole thing here on the Sharpe ratio, how it works. I've never used this, by the way. I only learned about this in the last 2 months. Actually, I think it was Anthony and then we're talking about it. I was like, I've never heard of that. And I went and looked it up. Yeah, this is all next level like stuff, but it's just an explanation. But there's a whole page here on risk-adjusted return and how it's calculated. And then finally, strengths versus weaknesses. Again, what's the strength of these 6 things and what's the weakness? And then what's the best practice for investors? If you're a quick deal, flyer, ROI, and gross yield, again, every estate agent and financial planner, that's what they give you. Buy-to-let analysis, you want net yield and cash on cash. Full investment modeling, you want IRR. I don't even agree with ROI, but you definitely want cash on cash, and ideally you would like risk on risk, risk-adjusted return. I don't think you need ROI there. For me, it'd be IRR, cash on cash, and risk-adjusted return. Valuing property in the current market, you need cap rate and net yield, so net income. Comparing rentals by area, you need gross or net yield and the cap rates, again, comparing apples with oranges. And comparing portfolios or funds, again, things in the listed market, you need risk-adjusted return. Final takeaway, to fully understand any investment, yield tells you how your income compares to the price. Cash on cash shows you how efficiently your cash is working. ROI gives you a simple overall result. IRR tells the real story, especially when timing and exits matter. Cap rate helps you benchmark deals across markets and value income-producing assets. And risk-adjusted return helps you determine risk versus return. Pro tip, smart investors don't rely on one metric. They triangulate between all 5 for a complete risk-adjusted. So what that's basically saying is, like in our case at Wealth Migrate, if I go over here, we always use what we think are the 2 most important ones, which are IRR and cash on cash. So if you look at any of our deals, they all have IRR. So they've got IRR, they've got cash on cash, and they've got the time frame of the investment. So that's sort of the breakdown. Right. Every time I do this, I'm like, wow. I was like considering I didn't need to do that. And then we did it. And I was like, wow, that was probably quite important. Any questions? I know that there's a lot of info that I just shared there. You should all have access to the document. It's there. You can go read it 500 times. But why I love what we did today and what I'm going to keep doing is in 2 years ago, you had to know all of this stuff. Today, you need to be able to speak English. Okay, why is that? Well, because if you know what IRR is and cap rate, and you know how to ask for it, then just ChatGPT it. It's one of 2 things. Either ChatGPT it, or whoever the salesperson is selling you something, ask them. Tell them, I want to know the cap rate, I want to know the cash on cash, and I want to know the IRR for this investment. And if they don't know what they're talking about, put the phone down. And can you see why 99% of people are dead broke, reliant on the government, or financially trapped at 65? Because no one knows what the hell they're talking about. Like their financial planner's like, oh, I'm giving you an ROI of 50%. You're like, that is flipping amazing. You must be the cleverest man I know. But you don't think to ask that it's over 10 years and therefore you're getting 5% a year, gross without any income and their fees coming off, et cetera, et cetera, et cetera. Basically, you're getting nothing. But they love to sell it to you at 50%, don't they? With T's and C's down on page 36 that no one knows about. For example, cap rate in Umhlanga, Durban will be lower than central Durban. Yeah, completely. So if you've got an area with that's much better, like central London will have much lower cap rates than Birmingham. Or in your case there, Miriam, Umhlanga, which is the best part of Durban. I actually, to be honest, I think Belito would have even better cap rates. But the best areas will have lower cap rates because there's less risk. And obviously, the worse the area, the higher the risk, the higher the cap rate. At the moment, development doesn't work as development costs per square meter are high and exceed the value by the time you take into account. Yeah, so that's the other problem that I didn't even go into. I didn't want to sort of confuse people, but I agree with you, Safina. You can also have a building where you're halfway through the building and then COVID happens and building costs go up. And, you're basically caught with your pants down because you've done all the modeling, you've sold the properties, but the costs go up. So it's one of the things that's another metric that's very, very very, very useful. It's not a financial metric, but it's a very, very thing, which is called replacement cost. So what Safina's just said there, let me actually show you this on a spreadsheet because I think it's worthwhile. So let's do this because there's a very, very valuable metric that you'll see me talking about a lot. Okay, so let's say the value of this property, the land, is 500,000 to buy the land. No, that's 50, 500. Okay, and to build is, let's just do the maths here. Like, I don't know, let's just, Safina, how much does it cost per square meter to build right now in England? I'm trying to like do conversions in pounds and rands and everything in between. I don't know. I haven't built in England forever. So what does it cost per square meter or square foot at the moment to build? Anyone, can you tell me in England, what is it roughly? Or do I need to ask my friend? There we are. Okay, 1,500 to 2,000. Okay, so let's just go on the lower end. So 1,500. So what Safina's basically saying is that to build in England costs £1,500 per square foot. Okay, so I'm just going to put you, so per square foot. Okay, oh, no, that's supposed to be a Q. Okay, now let's say that you're building 1,000 square foot building. Okay, now again, 1,000 square foot is 100 square meters. Just simple maths, you divide by 10. But anyway, okay, so to build this
But it's square meters.
Oh, do you say square meters? Okay, well, okay. So, well, that's maybe a bit big than this building. Let's make it 150 square meters. Okay. So I didn't see your meters there. Okay, fine. Square meters. Okay. So basically to build this building is going to cost you that. So the total price to do this building now, and that's not even taking into account all the other ancillary stuff, would be your land plus your build costs. Okay. Are you with me? Or are you all with me so far? This still looks a bit low because the land price wouldn't be that high, but I don't know. Okay, let's just say we're building a 500 square meter building. Okay, now you've got to add on additionals because there will always be additionals of at least 20%. So you've got to go that times 1.2, guaranteed there'll be additionals. So this here now becomes that plus that, okay? So to buy this building, or not buy it, to build this building for right now, to buy the land and build the building will cost you £1.4 million. Yep, you're with me so far? Now, if I can go and buy a building down the road, a second-hand building, and I can buy it, it's this building over here, just by the way. So it's the same building, okay? And the same building I can buy right now because it's a 10% cap rate at $1 million. I know the currency, just don't worry about the currency, just pretend it's whatever. Can you see that I'm buying this building at below replacement cost? So I'm buying this building at 29%. So I'm buying this building at 29% below replacement cost. Now, why is this important? So Safina and I are having a competition. We're in the market together. I have an existing building that I've bought for 1 million. I can make my rents a bit cheaper because I bought it for 1 million. She's gone and bought a piece of land and she's developed and she spent 1.4 million. Now she's got interest payments to make and whatever, so she has to charge more rent. So what this automatically does is it means the price of rent has to go up if there's more demand, and it means the price of building needs to go up. So what's very, very important always is if you're buying an existing building or a second-hand building, whatever you want to call it, you always want to buy it below replacement cost. And that's it. That's the end of that metric. So I don't know if you know that, but whenever we buy stuff, you'll hear me talk. Hopefully now you'll actually start to understand this lingo better when I do updates. But like you'll try and buy a building, and if it's an existing building, you want to buy it below replacement cost, because then you're protecting yourself. Because technically, no one can build that building for cheaper than what you've already bought it for. And therefore, you're in a much better position. Sometimes you've got to renovate. So obviously, you've got to take that into account. But when you compare an apple for an apple, you want to make sure you're buying below replacement cost. If you're buying above replacement cost, you're an idiot. Fact. Yep, Richard said, try and make your money when you buy property. Can you ask those same questions for a private equity deal? Yes, completely, Mark. 100%. Obviously, different metrics for different assets, but yeah, IRR is the one you can ask for every investment there is, because it is what it is. So we have 4 minutes left, because I actually have a hard stop. I've got the investor update now at 1 o'clock. Any final questions or thoughts? I do think this is a topic that you can never learn enough. It's taken me longer and longer, or it's taken me a long time to get clearer on how to explain this. I've got lots of videos and stuff I've done over time, but hopefully it's starting to land. And I do think repetition is the mother of skill. And I apologize for some people like Safina that are, way ahead of the learning curve. And obviously it's quite hard. There's different levels here. But hopefully that helps. And I did record the session. So as I said, I'm on the Tony Robbins AI course at the moment. And when it goes over the top of people's heads, they just say, well, go watch the recording. Just go watch it again. Read it 10 times, listen to it 10 times. Do you know how I learned this stuff? Just by the way. I did a course with Dr. Han Estrella called Property Something. I can't even remember. And it had DVDs. I bought the DVDs. I watched those DVDs over and over and over again until I could talk to you about this. I never learned this at university. I didn't learn this. I learned this by watching DVDs over the same DVD over and over again until it made sense. And then obviously you learn through experience as well. Okay, ladies and gentlemen. Well, I think that's all. I'm always, just by the way, I'm going to keep going through the rhythm of these of the different wealth transformation pack. But again, if there's any questions, I always want to start with questions. And if we happen to delay a week, doesn't matter. Like, as long as we're learning, that's all I care about. And if you ask me a question I don't know, excellent, because then I really have to use ChatGPT. Oh, by the way, I've got to show you something really cool. Put it in the chat room quickly if you'd like to do this. So I'm literally in the process right now of designing a course. But check how cool this is. I now have my entire own clone. And in that clone, I have my personal DNA, I have my business DNA, and I have my writing voice. So this knows absolutely everything about me. I now go and generate my own prompts. So it creates the perfect prompts, not for you, not for Shona, not for Safina, for Scott Picken. There's no one like me in the world. These are the perfect prompts just for Scott Picken. Okay? You can't tell me this shit's not cool. There's like content repurposing, like book recommendations. And I'm just getting started. Okay, and so what we're going to do next year, I haven't finalized the dates yet, but I'm going to help you build your wealth plan. Okay, so imagine having your personal wealth advisor in your pocket. It's going to have your wealth Enneagram all in there. It's going to have all your profiles. It's going to have all your models. It's going to have everything that we're talking about right now in your own wealth plan. And all you have to do is be able to speak a language. If you can open your mouth and talk, then you can use your clone. How cool is that? I think it's pretty flipping cool. Because Marge sits here and goes, I don't know, should I do, Marge, I was picking on you. Should I do this private equity investment? I'm like, I don't know, Marge. But I can tell you what, your wealth phone will know. If all of your wealth EQ data is in there, all of your Calio family office planning is in there, everything's in there. And it's like, does this deal make sense? Yes, no, maybe. I don't know. Pretty cool, huh? Anyway, that's what Scott Picken was doing last night. And with my business coach and everything, I've been working on this for the last month. So yeah, you guys are first to know about it. My own team doesn't even know about it. So this is that moment when Alex goes, I hate you, Scott, because you bring out more new shit. But the good news is Yak was already on it with me, and he's up here next week, Saturday, and we're going to spend 2 days working on it. because what I'm very good at is coming up with the ideas, but where I need someone to help me with is the substance. And so he's going to help me build all the substance. So everything we've been playing with, the wealth game, the freedom calculator, everything, it's all going to be built into this. And we're going to change the world, and we're going to make $10 million in 24 months. You're the first to hear it. Bye-bye. Cheers, everyone.